Ladies and gentlemen, hi, my name is Webster. Welcome to this video class where we're going to focus on the revision of the June exam that we wrote, which is Puma Limited. So the objective of this video class is to go through the case study and get a deep understanding of it and get a deep understanding of the required as well. So you realize we always talked about this to say the objective of the 30 minutes reading time is not to come up and anticipate what type of required or to try not the all the issues which are in the scenario, but rather the objectives of the 30 minutes is to really read and understand and get to understand where is this case study going, what is the entity all about, what do they do, okay? And then once you get the required, then try to understand what are the expectations, which are the what do they want me to do. I think once you do that, it becomes easy for you to actually structure your suggested solution which you want to give to the examiner. Okay, so I'll start with going through the case study. I think let's look at how would you get a deep understanding of the case study. So firstly, I think the first thing to note is this case study was broken down into two. It had question 1, which was giving you 68 marks, and it had question 2, which was giving you the remainder of the marks to get up to 100 marks. So when we go through question 1, we realize that the first thing to note is, I think, the company name. We're dealing with Puma Limited, which is a Zimbabwean company. So I think all of this paragraph, when you look at this is simply giving you the background story of the entity. They're listed on the ZSE. Their year end is 31 December. So that means we're going to be dealing with a financial period which begins in January and it ends in December. But in the current year, we are told that the financial statements have not yet been published, and they'll be published on 31 March 2019, or they were published on 31 March 2019. But we see board approval for the release of the financial statements took place on 22 March over there, and we also see that there's an annual general meeting which took place on 25 March 2019. So basically, this talks to the current period that we're dealing with is probably going to be, we are dealing with the 31 December 2018 financial period, which means when I look at this, if I'm going to put a timeline, I'll then say we are starting in January and we're ending in December. So 2018 is the period that I'm dealing with. However, the financial statements were actually approved for to be published on 22 March, which is somewhere here. So we then see that this period between December and the 22nd of March, that will constitute the period which we then consider to any events which might be taking place as to whether we should adjust or whether we shouldn't adjust. But anything which is subsequent to that period, nothing then gets adjusted. It's now concerning the next period, because the financial statements have already been approved to be published. Okay. So basically, in a nutshell, that was the information which we're getting there. But as we go down here, we are further told that the finance director requires your assistance in terms of clearing up some outstanding issues with related to IFRS. And they then gave you some information which is sitting in this table. So some of the issues which we're going to encounter, obviously, based on this table that we've been given, are related to inventory. Some of them are related to PPE. Some of them are related to investment property. And you also see some financial assets over here, which means we'll also expect some IFRS 9 to come through. And the issues are probably going to be noted in these notes. So it's important for us then to link. When we look at inventory, note 1 is probably going to be dealing with inventory. The note 2 is probably going to be dealing with PPE. So you can actually see the structure of the case study now starting to come out. Okay. So let's further go down and see what's happening. So when you go to notes, and we'll start with the, I think, what they're telling us about these notes. What are these notes all about? So they say here, the draft schedule above still has to be finalized and confirmed with the information in the notes below. Thus, the information below can be used to adjust the schedule above. So that means the schedule that we saw just above there, which is up here, this is preliminary balances. So which means, as we see here, that raw materials are 144, finished goods, you can actually see that there's a question mark here, which means there's no figure for finished goods as yet, which means it's our duty, we are likely going to be calculating this figure. And then PPE as well, we see we've got 1,176,000, which they're giving us there. But this is a preliminary figure, and the information that we're getting in these notes now is being given to finalize on these figures, which means there might be some changes which can take place. Okay, so let's further go down and see. So we'll start to deal with the information which is relating to inventory. So when I look at the structure of information which has been given for inventory, it seems as if that for inventory they gave us information which is relating to opening stock, as you can see here. Then we've got some purchases, as you can see here. Then as we continue to actually go down, we actually also see the purchases are denominated into local as well as foreign. And then further going down, then we also see other raw materials which have been procured, production costs. Under production costs, we've got direct labor, other direct costs, fixed overheads, and then lastly, down here we see the closing stock figure. So as I look at this information which is relating to inventory, you can actually see that this is costing of inventory which is taking place again. But just to get further into in detail in terms of what is this whole thing all about. So when you look at opening stock, we can actually see over here that our opening stock, there are no finished goods which were there. So there's no opening balance of finished goods which were there, which means the opening stock that we're looking at is we're looking at raw materials which were a value of 118, and we're also looking at work in progress which were a value of 220. So that means that's the stock that we began the year with. And then further going down, we then see some purchases taking place. So they further went on to purchase some raw materials. So the purchases which were made locally, Puma acquired leather material from local suppliers at a cost of 938,400, including VAT. This information is important, ladies and gentlemen, to note that there is VAT here. And I'd actually put it on the margin and say there is a component of VAT which is sitting here, because I understand from my technical knowledge that when we are counting this VAT, I can actually claim it back. So this can be input VAT, which means when I look at the actual value of my raw materials that I'm going to load as part of the costs when I'm costing my product, I shouldn't cost the VAT which I know that I'm able to recover it back. So this is not a cost to me. Okay. And also we see a 2% electronic payment tax which is over there. And from my understanding, this is a tax which is not refundable, which means this tax can actually form part of my cost of the product, because it's not refundable tax. It's different from the tax of VAT which we have over there. Okay. Then let's further go down. Then we've got some foreign supplies. So Puma acquired its fabric raw materials from India, and of late the suppliers required Puma to prepay for its raw materials before supply is dispatched. Now something interesting is coming through here. They say that the supplier asked Puma to prepay for the raw materials, but these raw materials are being bought from India. Now, do you remember the standard which covers the concept of when you've got a prepayment of a foreign supply, IFRIC 22? So that means there are some provisions of IFRIC 22 that I may be expected to apply here. So they say Puma makes a single order for the year of fabric raw materials from India, and they paid the Indian rupee, which amounted to 4,500,000, which was paid in advance on 2 January 2018, when the exchange rate was sitting at 71.04. Then the inventory was shipped free on board on 20 January 2018, when the exchange rate was 72. Then Puma paid 50,000 freight costs and 82,000 duty and bonded warehouse storage costs at the border waiting for clearance. So you can actually see the costs coming through now to bring the foreign supplies, which means when I want to cost the foreign supplies, my cost of my inventory, obviously, all the costs which I've incurred until the inventory is at a present location where I can actually sell it. So that means the 82,000 I'm going to include it, the 50,000 I'm going to include it, as well as the purchase price which I purchased from India, I'm also going to include it. But the challenge which is here is this 4.5 in rupee, I need to translate it to the local dollar. So at which rate am I going to translate it at? Is it at 71 or is it at 72? I think when you go back to your IFRIC 22, it talks to the amount which we consider as part of the cost of our product is the amount which we actually paid. So when you look at it, the amount which we actually paid is we paid when the rate was at 71.03, not at 72.1. So 71.04 is the amount that the rate at which we're going to use, and there will not be any subsequent adjustment of the gain or losses between the date of payment and the date at which we obtain control of the inventory. Okay, so you can actually see this is the aspect of the concept which is being tested over here. Okay, then let's further go down. So you see, deep understanding, I'm understanding the case study as it goes. Then other raw materials which were procured, a truck transporting raw materials was involved in an accident in Mapinga and the driver passed on. So all the raw materials for 138,000 inclusive of VAT was burnt beyond salvage. Now when we look at this, it seems as if that we've got raw materials that we had purchased, but these raw materials were destroyed at the point at which this accident happened. And also to take note is it's inclusive of VAT. So which means the amount of these raw materials, if they have been damaged, can I still take these raw materials and take them to form part of my production cost? I think obviously when you look at your costing of your inventory, you've got normal and you've got abnormal. Okay, and if I was to classify this loss, I don't think I would classify it as a normal loss. This is not something which is normal, which happens on a day-to-day in production of our inventory. So this is something which is kind of abnormal, which means I cannot take this and form a part of my costing of my inventory. Okay, so that was important information that we had to take note of. Then further going down, they talk about production costs. So direct labor costs are paid per hour to the factory workers. Then there are 420 labor hours which are there, which were logged into the system, paid at an average rate of $10 per hour. And included in the labor hours are 12,000 hours downtime due to labor dispute in October 2018 when the factory workers were striking for a wage rate increase. Again, we can see here that we have got total 420 hours which have been logged for work which has been done. But part of those 420 hours, 12,000 of them, there was nothing productive which was being done. So that means these 12 hours, this 12,000 hours, this is actually a loss that we've incurred as a business, because people are getting paid, yet people were not producing anything. So the question now is, what do we do with the costs of these 12,000 hours? Since this is a loss, again, the question becomes, is this a normal loss or this is an abnormal loss? Okay, so you come back and look at strikes, ladies and gentlemen. Do you think strikes are normal? Are strikes expected in the normal production of inventory or of goods? I don't think so. So these strikes are once off, they happen here and there, and we didn't expect them as part of what happens on a day-to-day basis. So that means I will classify these 12,000 into abnormal again, which means I cannot transfer this loss to the customer. All right. So I think that was second important information that we had to get over there. Then other direct costs are 230,000 were incurred during the year. Fixed overheads including depreciation at 345. Good information, which is then Puma has got a capacity to manufacture 22,000 shoes every year, but only manufactured 18,000 shoes in 2018. Now this is also good information. Remember, ladies and gentlemen, for costing of your inventory, when you look at the cost per unit, you need to divide by normal capacity. So despite the fact that we actually produced 18,000 units, we are going to look at cost per unit based on normal capacity, which means the 22,000 is what we're going to use. But then to look at the total cost of production, then take that cost per unit and multiply it by 18,000, because those are the units that we actually produced. Okay, so I think important information that we have there. So that means our closing stock becomes our total stock, the total value of our stock becomes the 18,000 multiplied by whatever unit cost that would have found. So this 22,000, remember, this is for when we want to allocate our fixed overheads. Okay, important information over there. Then we are also told that due to the depressed economic activities at the end of the year, so 30% of the shoes were produced, which were produced, were not yet sold by 31 December 2018. In other words, during 2018, we did not start with any stock which was finished goods, but we produced 100%. in 2018, but by the end of the period we only had 30%. So this becomes our closing stock balance of finished goods, which means in the year we actually managed to sell 70% of the stock. I think that's also important context which was coming from the scenario that you had to pick. Now, raw materials closing balance is 144,000, which is at hand. The replacement value is 122,000 at the same date. I think you can actually see the concepts being examined here. So we are given that they bought these raw materials at a cost of 144, the ones which are still there at the end of the year. But if we try and replace them today, we need to fork out 122,000. So when you look at the valuation of your stock, be it raw materials, be it closing stock, be it work in progress, we always know that the standard requires us to value our stock at the lower of costs and net realizable value. And if we're going to realize these raw materials, we can actually see that we cannot realize 144 anymore. We can only realize to an extent of 122,000. So that means that over here we actually see that there is a certain level of impairment or write-off of inventory on raw materials that we need to do. Then Puma was selling the shoes at an average selling price of 120 per shoe. However, from 20 February 2019, counterfeit Chinese shoes flooded the market after the devaluation of the Zimbabwean dollar against the United States dollar after the RBZ monetary policy pronouncements. So from this date, the Puma sports shoes were now selling at 105 before deducting $5, which is selling cost. Okay. Now, good information that we have here, which is we now know that for the period of 2018, we are told that by the end of the year, the inventory was selling at $120. So which means this can be assumed that the sales for 2018 were at $120. But the problem now is when you look at subsequent to that, the selling price then dropped to 105 before we consider selling cost, which means it actually came to 100 if we look at the net realizable value. So it's coming back now to saying we did some costing up there of our product. If we did our costing of the product and the finished goods, if the costs goes above 100, then that means we've got a problem. We need to write it down from that cost which is above 100 to come down to 100. But the problem is this is only taking place after year end, which makes sense now. Do you remember if we go up here, we were given information in terms of the dates of the financial period as well as the dates of the events after reporting period. To what extent can we consider? And we see that this event is only coming to take place on 20 February here, which is within the range, which is where we consider events after reporting period. So this is actually a report after reporting period. So the question is for us to go ahead and talk about the impairment of finished goods, we need to look at if this is an adjusting or if this is a non-adjusting. Is this giving evidence of something which existed as of 31 December 2018? And I think as you can clearly see here, the cause of the impairment might be having been caused by the events which took place from 20 February 2019, which means these did not exist as of 2018, 31 December. So this becomes a non-adjusting event. So you see, this is important information that we got. You've got deep understanding of what are the issues which are there relating to inventory. Okay, so good stuff over there. Now I think let's quickly look at the required which was there. So when I look at the required is quite simple. We've got a number of requireds which are looking at inventory, and I think when I look at the total number of requireds which were relating to inventory, it's from A getting to C over here. All of these were relating to inventory. So the number of marks, 5 over there plus 15 over there to make it 20. So 25 marks in total were covering inventory. A quarter of the paper was actually related to inventory. Now the first one says discuss the recognition and measurement of the cost of raw materials purchased from the Indian supplier. Now quite a good question, But look at this now. This is only for 5 marks. And of those 5 marks, 1 is for communication. And the type of communication that they want is clarity of expression. This is an easy mark, ladies and gentlemen, that you need to get. Be clear. Express yourself clearly to the examiner. So I expect everyone to have gotten this 1 mark. Then the other 4 marks, what are they for? Discussing the recognition and measurement of the cost of the raw materials. So at what point should we be recognizing? When should we be recognizing those raw materials? I think that was quite simple, ladies and gentlemen. When do you recognize? The standard is quite clear on that. You recognize when you obtain control of the goods. And if the cost and the economic benefits can be measured reliably. But most importantly, when do we obtain control of these goods? Okay. So some people, I think, let me make a distinction of, if you're writing ITC in June 2018, you are still expected to be using, if you're writing ITC June 2019, you're still expected to be using the old conceptual framework, which means you could talk about the risk and rewards because that is sitting in the old conceptual framework. But if you are writing ITC for periods beginning 2020 going forward, you're expected to be using the new conceptual framework. And when you go back to the new conceptual framework, it doesn't talk about risk and rewards anymore, but rather it talks about if you obtain control. And if you obtain control, to prove control, you don't talk about risk and rewards anymore, but you talk about, do you have the power to direct the economic benefits related to that? Are you able to restrict other parties from obtaining the economic benefits related to that? So that was the expectation which was there, ladies and gentlemen, with regards to recognition over there. Obviously not too much information. This is just 4 marks which is required, and maybe 2 marks only for recognition. Now when you look at measurement, I think measurement also had a number of marks which were coming from there, but what was just important for measurement was to note that IFRIC 22 was applicable there. So when you're looking at the purchase price, you're supposed to divide it by to translate it at that rate of 71.02, which was the rate at which the payment was done as per IFRIC 22, and then the rest, all the costs which were incurred to bring the inventory to the present location for them to be sold. So which was the 50k plus the 82k, which is for the duties and the warehouse bonding and stuff like that. Okay, so very, very important. A lot of people managed to get the 82 and the 50, but I was disappointed a bit by the people who failed to get that IFRIC 22 was an issue here. Then part B, with reference to Note 1 again, calculate the costs per unit of the finished goods and present an extract of the statement of P&L. Now when you talk about calculate the costs per unit, okay, this required, ladies and gentlemen, these 11 marks, these were just giveaway marks. To be frank with you, this is a kind of required which is not even expected at CTA level or even at ITC level. This is basically a second year type of required. Simply calculate this. As you already know, ITC will not give you any type of required which is like this. Okay, but this is just for boosting marks. But quite honestly, I was surprised at a lot of people actually failed to get this question, because at ITC level, what I was supposed to give you is maybe review something which has been done, or maybe can you evaluate a calculation which has already been done by someone else. But you cannot even review or evaluate if you can't even do it on your own. So a lot of people failed even to calculate the costs on their own, okay, which is quite disappointing. Okay, so I think this is one area that I was not quite happy with in terms of the outcome. But for those who did attempt diligently this question, they did quite well. Now, my greatest disappointment as well was when we look at the extract from the profit and loss statement.